When people ask me what stocks I would want to own going into a new year, they usually expect me to begin with a symbol, a ticker, a list, a ranking, a quick answer that feels decisive enough to sound intelligent and short enough to be useful on a screen. I understand the appeal. Lists feel neat. Markets are not neat. A stock pick only means something if the structure beneath the pick is strong enough to carry it. Otherwise, you are not investing. You are borrowing conviction from a mood. I have never liked borrowing conviction from a mood. It is too expensive. It usually gets a man excited at the wrong time and afraid at the wrong time. So when I think about what I would want to own in a year like this, I do not begin with the company name. I begin with the current of history that is moving beneath the company. I ask a very old question in a very modern setting. What part of the machine is becoming more necessary? What part of the machine is hard to replace? What part of the machine is becoming more valuable precisely because the whole world suddenly depends on it? That is where intelligent concentration begins. Not with noise, with necessity. I want to say something to the person who thinks he started too late. That man is often more dangerous to himself than any market correction. He carries a hidden panic. He thinks the years that passed have somehow disqualified him from the years that remain. That is nonsense. I began investing later than many people would consider ideal. I did not begin as a child genius with a brokerage account and a lemonade stand parable. I worked, I served, I moved through life in an ordinary human order. And yet I still arrived at a point where the machine was strong enough that I no longer had to sell my days in the same way. That matters because too many people believe they missed the door simply because they did not find it at 23. The door is still there at 31. It is still there at 40. It is still there later than people think, provided you stop demanding drama and start demanding structure. That is where this whole discussion lives. Not in luck, in structure. The broad structure that still matters to me now is simple to state and difficult for the public to appreciate in the right order. Artificial intelligence is not merely software. It is not merely a chatbot. It is not merely the latest theme for speculative mouths to repeat at cocktail parties. Artificial intelligence at industrial scale is infrastructure. It is compute. It is networking. It is memory. It is data center, real estate. It is power generation and delivery. It is the full stack that allows enormous volumes of information to move, train, infer, answer, and improve. And whenever the world is fixated on the glamorous layer, I start paying unusual attention to the layers beneath it. Because the glamorous layer gets the headlines. The enabling layers get the money. This is not a small distinction. It is one of the oldest distinctions in capitalism. The public falls in love with the visible miracle. The smart investor studies the toll roads, the switches, the tools, the boring machinery that the miracle cannot function without. That is why I still find myself drawn to the same broad cluster of ideas. Artificial intelligence infrastructure, data center networking, semiconductor equipment, specialized compute power, and a few carefully chosen businesses that stand where demand is not just exciting but almost mandatory. I will tell you plainly that I do not care for stories built only on possibility. Possibility is too cheap. The market hands out possibility to almost everybody in a hot theme. What I care about is proof. I want to see revenue that has already moved, margins that already widen, cash flows that already converted, backlogs that already exist, customer relationships that already survived the courtship stage and entered the habit stage. This is where many people make their first serious mistake. They buy a story the moment it becomes emotionally irresistible. I prefer to buy a business when the numbers have already begun making the emotional story less optional. That is how I think about the first company in this group, Arista Networks. When the public hears artificial intelligence, it thinks of chips. That is understandable. Chips are visible. They are easy to turn into symbols. But if clusters of compute are going to function at scale, the network fabric becomes a point of truth, not a side detail, a point of truth. The graphics processors may get the applause, but the switching, routing, and software layer that allows those compute clusters to operate together is not decorative. It is essential. Arista lives in that layer. That is what makes it interesting. Not that it is merely adjacent to the trend. It is embedded in the physical and operational necessity of the trend. Now, if a company lives in a necessary layer, that does not automatically make it a wonderful investment. Necessity without operating excellence can still be mediocre. So I want to see what the business actually did. In the source material, Arista's revenue moved from roughly $2.3 billion in 2020 to an estimated $8.5 billion in 2025. That is not a cute move. That is a serious industrial expansion. The net margins did not merely hold. They expanded from the high 20s into the low 40s. Free cash flow margins crossed 50%. Cash piled up on the balance sheet. Debt stayed almost trivial. That combination is rare in infrastructure. Most infrastructure businesses ask for endless capital, then apologize for their margins. Arista is showing the opposite pattern. Scale arrives and profitability accelerates. That is why it deserves attention. Fay-Filocyte, Fay-Turn 46 file, 0 Fay people. Always underestimate what it means when profitability scales faster than revenue. It means the business was not merely selling more. It was improving the quality of what more meant. That is an important distinction. A man can double revenue and still build a weak business. If the economics beneath the growth are soft, but when the margins widen with the scale, you begin to see operating leverage behaving like a friend instead of a rumor. That is what I like. The market may still argue about valuation, fine. The market can argue about valuation with every good business that keeps proving itself. What matters to me first is that the business is doing the hard thing. It is scaling without becoming sloppier. That is the sign of a company that may be becoming more central, not less. Now let us move to Applied Digital. This one is different. Applied Digital is not the refined cash printing machine that Arista already appears to be. It is more developmental, more exposed to execution, more dependent on bringing facilities to life and monetizing them properly. That means the numbers must be read with greater care. I like that sort of situation only if the physical constraint being solved is real enough. In this case, the physical constraint is power and density. That is very real. The world likes to talk about artificial intelligence as if it lives in the cloud in some poetic sense, as if it were pure thought floating overhead. The cloud is not poetry. It is steel, land, cooling, electricity, and giant bills. When a business can secure low-cost power in regions where capacity matters, it is not solving a cosmetic problem. It is solving one of the core bottlenecks that everyone else is eventually forced to price. Applied Digital's growth looks almost theatrical when stated plainly, from single-digit millions in fiscal 2022 to more than 200 million in fiscal 2025, with a higher run rate implied as major facilities come online. The source makes the point clearly that this is tied to low-cost electricity, to large-scale AI data center build-out, and to the fact that one campus coming online can add roughly $50 million per quarter at first and more later as capacity ramps. In other words, the valuation argument here is not really about today's perfection. It is about whether the capacity becomes productive on schedule. That is an execution question, not a demand question. Fay-Filocyte, Fay-Turn 46 file 0 Fay. I like when the key question is this explicit. Too many businesses are sold through fog. This one, at least in the way it is framed, says the quiet part out loud. If the megawatts get placed into service, revenue steps. If execution stumbles, the dream gets delayed. That is clear. I prefer clarity to charisma. The next name forces a very different conversation. AeroVironment, this is not artificial intelligence infrastructure in the same direct way. But it sits in another large current I take seriously, which is defense technology and the mechanization of conflict. When a company moves from being a niche supplier to becoming a more integrated platform through acquisition and product expansion, the numbers can look bizarre in the short run. Revenue can jump sharply. Margins can look uglier than the new believers expected. Investors then have to decide whether they are seeing deterioration or transition. That is always a dangerous place because the screen alone does not tell the story. In the material you gave me, the revenue jump was clearly tied to the BlueHalo acquisition, while margin pressure came from the heavier service mix and amortization effects. That matters because not every margin collapse means the business model is weak. Sometimes it means the accounting shape changed faster than the long-term earning structure. The deeper point in the source is that the Switchblade system is combat-proven, backlog is expanding, and the company is trying to become more than a one-product hardware name. That makes this a scale, an integration story, not a neat straight-line quality compounder yet. Fay Filosite Fay turn 46 file 0 Fay. I will tell you something unfashionable. I like businesses that have already survived contact with reality. That is one reason defense interests me when the underlying technology is real. War is not a simulation, a product that remains valuable after being asked to function. In conditions that do not care about PowerPoint is worth more than one that has only lived in demonstrations. That is part of what makes a business like this interesting, not because because proof under pressure is rare. Now let us discuss IonQ, because this is where investors are most likely to leave the territory of disciplined probability and wander into the circus of technological romance. Quantum computing has enough mystery around it to intoxicate people who are already too eager to believe in dramatic breakthroughs. That is dangerous. Anytime the language becomes technical enough that the average investor feels unintelligent, the average promoter gains an advantage. I dislike that. So I reduce it to something simpler. A business like IonQ interests me only if it is moving from laboratory legitimacy toward actual commercial behavior, not if it has cool words around it, not if it can recruit believers. Only if revenue and customer embedding are beginning to exist in a way that changes the shape of the enterprise. The source material points out something useful. Quarterly revenue moved from the low teens into nearly 40 million in one quarter, and the company is willing to tolerate weak gross margins to establish the platform early. It also highlights fidelity advantages in its technology and frames the recent stock move not as a broken story after a drop, but as consolidation after a huge repricing. That is the right way to think about this sort of name. The stock is not the business. The question is whether the business is moving from experiment to platform. If it is, the equity may still matter. If it is not, the story will continue to be much prettier than the economics. Fay Filosite Fay turn 46 file 0 Fay. This is where discipline matters most, because the market loves to make a man feel brilliant right before it reveals he was only excited. I would rather miss a little drama than own too much illusion. That is the principle I want near every frontier name. Now let us speak about NVIDIA. A great many people have become lazy in the presence of NVIDIA's success. They say it is obvious. Nothing is obvious that can evaporate half the market's confidence. If one line item disappoints, what NVIDIA has done is genuinely remarkable. And I say that without needing to worship it. The business is no longer merely a chip supplier in the ordinary sense. It has become a systems provider with compute, networking, memory architecture, and software layers that together make it far more than a components company. In the source material, data center revenue reached 51 billion in a quarter and represented about 90% of total revenue, while the new platform is described in terms of greatly improved inference and training economics. What matters to me is not the adjective around AI. What matters is that the token cost drops, deployments expand, and customers keep buying not isolated chips but whole racks and whole systems. That is platform power, not just hardware demand. Fay Filosite Fay turn 46 file 0 Fay. When a company moves from product to platform, the economics tend to change in its favor. Customers become less likely to compare only on one visible specification. They begin to buy integration, reliability, ecosystem, and compatibility with what they already built. That is where dominance starts becoming expensive for rivals. The market can still overpay for dominance. Of course, it does that all the time. But if I am going to examine the AI stack honestly, I cannot pretend NVIDIA is merely another chip maker standing at the buffet. It is currently the host of the meal. That matters. Now, one of the great errors I see in markets is that people think a company in the center of a trend is automatically enough. It is not enough. You also want the companies that supply the companies at the center. That is where Lam Research enters. Lam is not glamorous in the way NVIDIA is glamorous. That is one of its advantages. The work Lam does is buried deeper in the manufacturing chain. Etch deposition, the hard, dirty, necessary process layers that advanced semiconductor production depends on. And because the complexity of chips keeps rising, the amount of process complexity required to make them also rises. That is the kind of invisible tax on progress that can become a wonderful business if you are the one collecting it. The source shows Lam's revenue moving from around $1.6 billion in the mid-2000s to over $18 billion in fiscal 2025. While operating margins and free cash flow have scaled impressively, and the company has become more resilient through the cycle. The specific hook now is high bandwidth memory and the fact that advanced packaging and memory complexity increase the number of steps per wafer, which raises Lam's tool intensity. That is exactly the sort of structural lever I care about. It means the boom is not just in selling a final shiny chip. It is in selling more indispensable work to make the chip possible in the first place. Fe phylocyte, Fe turn 46 file 0 Fe, that is what I mean by necessity, not optional, add-ons, indispensable bottlenecks. Now, let me say something about Amazon that many investors still do not understand properly. Amazon is one of those businesses people misread because they confuse stock behavior with business behavior. Amazon stock has had long stretches of seeming laziness. The business beneath it has often kept evolving. That is important. A stock can go sideways while the company is laying pipe for a very different earnings power later. That does not guarantee the stock is cheap. It does mean boredom can hide value. And boredom is a friend to the patient buyer. The source frames Amazon as a company with a repeating pattern, bursts of outperformance followed by years of sideways consolidation, while the business catches up. It points to AWS re-accelerating, operating income rising dramatically from 2022 to 2024, free cash flow recovering strongly, and data center spending being funded from much stronger economics than before. I like that framing because it does not require Amazon to be a story stock. It treats Amazon as a business whose earning engine may be emerging into clearer visibility after a long period in which the stock merely looked stuck. Fe phylocyte, Fe turn 46 file 0 Fe, when a business improves faster than the public mood around the stock. That is often a constructive place to look. Not because it guarantees immediate reward, because it means the gap between business progress and emotional pricing may still exist. Now let us turn to AMD. This is where the market is most likely to play a crude game with optics. AMD is often judged through comparison rather than through its own forward structure. That is dangerous. A company does not need to defeat NVIDIA in some total war to be an excellent investment. It needs to be underpriced relative to the cash it can earn and the growth it can sustain. The source gives a very clear case. Revenue grew from around $10 billion in 2020 to $34 billion in 2025. Data center revenue is now the key profit engine. Cash flow is improving sharply. Reported earnings are somewhat clouded by non-cash acquisition, amortization, and the PEG ratio is strikingly low relative to the expected growth. That is the kind of mismatch I find interesting. The market may still be pricing AMD as though its growth is more doubtful or more temporary than the operating evidence suggests. That is not proof. It is an opening for analysis. Fe phylocyte, Fe turn 46 file 0 Fe. I never liked the lazy binary question. Who wins? That is a sports question. Capital allocation is usually more nuanced than that. A business can occupy a valuable second position or a complementary position or a lower valued growth position and still reward shareholders magnificently if the cash flow and market pricing are favorable. That is why I treat AMD not as a morality play, but as a valuation and execution question. Now, if we step back, a larger pattern emerges. Arista handles the traffic inside AI data centers. Applied Digital helps house the compute and power. Our environment connects to defense technology and the automation of conflict. IonKey represents frontier optionality in quantum. NVIDIA sits at the platform center of modern accelerated compute. Lam Research supplies the manufacturing machinery behind advanced chips. Amazon uses and monetizes cloud scale while benefiting from AI infrastructure spend. AMD is a lower valuation semiconductor growth vehicle with increasing data center importance. This is not a random pile of tickers. It is a map of belief. A map that says the world is moving toward more compute, more power demand, more networking intensity, more advanced semiconductor manufacturing, more software leverage over physical infrastructure, and more strategic importance attached to the hardware beneath all of it. That does not mean every stock will win equally. It does mean the theme is not imaginary. And when a theme is not imaginary, my next question is always the same. Which pieces of the theme are already proving themselves with numbers? That is why I care so much about revenue. Revenue is not the whole truth, but without it, most of the rest is theater. The source keeps coming back to revenue acceleration and revenue durability. And on that point, I strongly agree. In Arista's case, the revenue acceleration matters because it shows hyperscaler spending is not fading. In Applied Digital's case, the coming online of megawatts matters because revenue follows capacity. In IonQ's case, the step up in revenue matters because it marks the difference between research story and platform attempt. In NVIDIA's case, data center revenue remains the center of gravity. In Lam's case, the cycle and the process complexity show up in the top line. In Amazon's case, AWS and the improved earnings engine alter the valuation discussion. In AMD's case, data center and overall revenue growth collide with a compressed valuation profile. Revenue is not the only thing I care about, but without real revenue trajectories, these stories would be mostly adjectives. Fay file site Fay turn 46 file 0 Fay and I distrust adjectives in finance. Adjectives are cheap. Margins matter too. A business that grows revenue but never converts it into economics is a very different proposition from one that turns scale into widening profitability. That is why Arista's 40+% net margins matter. That is why Lam's operating leverage matters. That is why Amazon's operating income improvement matters. That is why NVIDIA's software layer matters. That is why Applied Digital's future margins are the whole hinge of the thesis. This is the adult version of investing, not theme worship operating structure. Now, I want to say one more thing to the person who feels late. It is easy to look at a list like this and think the game belongs only to the people who've been there forever. That is wrong. What belongs to the patient investor is not early birth. It is consistency once he finally sees the road. I started later than many people imagine. That did not stop time from helping me once. I stopped standing in my own way. That is why I dislike self-pity in investing. It feels like realism. It is usually disguised procrastination. You do not need the perfect past. You need the right behavior from here forward now. Does that mean buy every one of these names without thinking? Of course not. That would be idiotic. No intelligent person takes a thesis and turns it into blind obedience. But I would say this, if you want exposure to what I believe still matters over the next phase of the market, I want businesses that are standing where modern demand is moving, not where television nostalgia keeps people's emotions trapped. I want infrastructure around AI. I want compute. I want networking. I want the machinery behind semiconductors. I want cloud scale. I want selected frontier optionality. And I want businesses where the actual numbers are starting to justify the story instead of merely decorating it. That is the standard. When people ask for stock picks, they usually want the illusion of certainty. I cannot give them that honestly. What I can give them is a better filter. If a company is critical to a structural demand wave, if its revenue is already moving, if its margins or cash flow are proving quality, if its balance sheet is not begging for rescue, and if the market is not fully priced in the durability of that role, then I am interested. That is the framework. Everything else is noise. I have no problem with noise in music. I do not pay for it in a portfolio. So yes, going into a year like this, I would rather own the toll roads and machinery of the next compute wave than spend my time pretending I can guess which headline will make a crowd euphoric next week. The crowd is fickle, need is durable. And if I have to choose between what people are loudly praising and what the world quietly cannot function without, I will choose the second category far more often. That is how real fortunes are usually built. Not by sounding modern, by understanding what has become indispensable. And in this cycle, a great many indispensable things are buried underneath artificial intelligence, data center build-out, advanced manufacturing, cloud capacity, and the power structures that allow all of it to exist. That is the current. The companies may differ. The current is the same. I follow the current. Then I ask which boats are actually moving with it. That is the only way I know to discuss stock picks without becoming a salesman, and I have never wanted to be one of those. There is another reason I prefer this way of thinking. It protects a man from narrative whiplash. The market loves taking a sensible theme and turning it into a circus. One week it tells you AI has already changed civilization forever. The next week it tells you valuation matters again, and half the names in the same trade get punished together, whether they deserve it or not. If you do not know what layer of the machine a company occupies, you are at the mercy of that emotional weather. If you do know, you can endure more of the storm without losing your mind. That is why I keep separating the stack in my head. A company enabling compute at the network layer is not the same bet as a company building power, rich facilities. A semiconductor equipment name is not the same bet as a cloud platform. A speculative frontier company is not the same bet as a proven infrastructure compounder. The public tends to flatten all of them into one thing because the labels are easier that way. I do not like easy labels. They make the mind lazy. The same discipline applies to valuation. A magnificent business can still be overloved. A second-tier name can still be underpriced. A company in transition can be temporarily ugly in a way that creates opportunity rather than danger. That is why I always want the numbers next to the story. Without the numbers, a story is just marketing wearing a suit. With the numbers, you at least know whether the story has learned how to pay rent. This is why I respect the data-first instinct in the source material, even though I would express it in a different voice. Revenue acceleration, operating leverage, cash generation, balance sheet strength, backlog, embedded customer position. Those are grown-up words. Those are not the words of a man who is merely trying to sound fashionable. They are the words of someone trying to understand whether a business is actually moving from possibility to necessity. That is the bridge I care about. Faithful site Fayturn 46, file 0 Fay. It is also why I am not interested in pretending every company here belongs in the same size position. That would be foolish. A man does not size Arista the way he sizes IonQ unless he enjoys turning his portfolio into a moral lesson. One is much more proven. One is much more speculative. One is already printing the sort of margins that make my attention sharpen. The other is still persuading the world it can become a real commercial platform at scale. Both can be interesting. They are not equally certain. The same is true of Applied Digital and Amazon. One is proving out physical capacity and execution in a constrained environment. The other is a vast operating system with a cloud engine that may be exiting one of those long boredom periods the market imposes on businesses while the economics quietly improve. The point is not that all good ideas should be treated as equal. The point is that all good ideas should be understood clearly enough that they can be sized. Honestly, That is part of capital discipline too. Now let me say something about envy. A lot of investors lose money because they are constantly trying to own what would make them feel least foolish in front of someone else. That is a terrible way to build a portfolio. It leads to crowded trades, late entries, and emotional exits. If a business is structurally sound, it does not need your envy to justify it. And if a business requires your envy, it probably has less real justification than you think. That is why I would much rather own the hardworking layer of a trend than the most memed layer of it. The hardworking layer is where the bills get paid. It is where the customers keep coming back because they have no serious alternative. It is where the world becomes increasingly dependent in ways that are too practical to debate endlessly. That is the sort of dependence I trust. Not the dependence of fashion, the dependence of necessity, and necessity in the end is the investor's best ally, because necessity endures even after the mood changes. If I have learned anything worth repeating in markets, it is that the mood always changes. The work being done underneath the mood matters much more. That is why I keep coming back to the same broad conclusion. I do not want the prettiest story. I want the companies doing the work the next decade cannot easily avoid paying for. That is where the money usually hides before everyone else starts calling it obvious. By the time the crowd calls it obvious, much of the easiest money is already gone. The earlier discipline lies in seeing the necessity before the crowd finishes romanticizing it. That is the task, not prediction. Recognize where the world is going. Recognize which businesses have already begun proving they belong in that future. Recognize which ones can survive scrutiny of the numbers, then size them with honesty, hold them with discipline, and let time do the one thing it has always done for intelligent owners of productive assets. It separates the essential from the theatrical. I am interested in the essential. I have built enough of my life around that principle to know it works well beyond markets. And when it comes to 2026, that principle still leads me to the same place, toward AI infrastructure, toward semiconductor and networking picks with real operating evidence, toward cloud and compute businesses where the machine is still being built out beneath the surface, toward carefully measured exposure to frontier names without letting frontier excitement rewrite the laws of position sizing. That is not a list. It is a worldview. The list comes later. And if the worldview is right often enough, the list has a much better chance of working than if I had begun with a set of symbols and tried to invent the philosophy afterward. That is how I would want to invest. And that is how I would want anyone serious to think about a market like this.